Hello, performance management students. Steve here. In this video, I'm going to take you through the basic variances that are assumed knowledge from the MA exam. We'll go through the materials, the labor, and the sales variances. And we'll do that using this PM question, Marcus. Now, Marcus is not asking you for these basics, but the numbers are here, so we will use this question to do the review. You can find the link to this question below. I recommend at this point, pause the video, download the question, and even print it out if you can. Take notes on the printout as we go. When you have the question ready and you've reviewed it, continue watching. PM team, I've got the question open here. We've got the manager, Marcus, who works at company MN, and we have some results. We've got some actual results for the period, and we have the budget that was set at the beginning of the period. First thing we can notice, they were expecting profit of 588. They got profit of 141. So a bad quarter. Remember this, when we are performing variance analysis, this is a traditional tool of control. We're trying to understand what happened. We have a budget, we have actual results. We're asking the question, why are they different, so we can take corrective action? Now, look at the lines in the budget. Many things could have gone wrong. We have units. Look at this. They sold fewer units. Maybe they sold at a different price. Maybe they used more kilos per unit because they wasted some. Maybe they paid more money at the supplier. Maybe the workers took longer per unit. They went slower. They were less motivated. Maybe we paid the workers more than we expected when we set the budget. Team, variance analysis helps us answer all of those questions so we can explain to anyone in the business what went wrong, why profit is actually lower than the budget. And in this question, why I've chosen it, we see a very important omission. Guys, we cannot properly control the performance of the company when we are comparing the budget to the actual, because the units are different. Imagine we run a restaurant. On Monday night, we have the food costs of $100. On Friday night, we have food costs of $300. We cannot say that on Friday we overspent and that we wasted materials, because on Friday we'll have 5 times as many customers. So in order to properly control the business and to calculate the variances, we need a flexed budget, guys. That's an important lesson from MA. This flexed budget is going to take the units from the actual column, 38, and the monetary values from the budget. So units from actual, monetary values from budget. And with the flexed budget, we can then answer the question, when we produce 38 units, we should get revenue of this, we should get materials of this. So team, first thing that we need to recognize with this question is that the flexed budget has not been presented. The next thing that we have to recognize from this question are these figures here in the left. All of the variable costs are presented with 2 pieces of info. We get the amount of something, we get the amount of kilos, the amount of hours, and then we get the rate. We get the kilos per hour and the dollars per hour. So look at that. We've got 2 components of the cost per unit. Team, these numbers here are referred to as the standard costs per unit. S for standard. Often they're presented as a standard cost card. Okay, team? So we've got two things we've looked at so far. The fact that they did not give us a flexed budget, and the fact that the standard cost card is presented to us right here on the left. Now, in this question, in order to do the basic variances, we need a little bit more info. We need to get the actual costs per unit for materials and labor. Look at this. They give us the actual spend here, but they didn't break that down to the kilos and the hours and the cost per kilo and the cost per hour. So look at this. If we go into the notes now, we can get all the info that we need. We can discover that the actual rate was 25% higher than the budgeted rate. So if the actual rate is 25% higher, 8 times 1.25, that will be $10, the actual rate, okay? Now we can get the actual cost of the kilos of the material is right here. Okay, team, so we've also got the actual cost of the materials. We can call that the actual price. So 4.4 actual price, team. At this point, let's move over to a spreadsheet so we can go nice and quick and we can work neatly. So I'll see you in a moment in my spreadsheet with all of this information ready to go. Guys, here's my spreadsheet. I took a moment to set this up. Here on the left side of the spreadsheet, I copied in the important information from the question. Here on the right, I've reproduced, okay, the P&L. And look at this. I did something a little bit different. I am going to work to contribution, not to profit. We're going to do it using marginal costing. And in your PM exam, they do it this way. They do it in marginal costing, working to contribution. Don't worry about the absorption costing variances that you met in MA that might be in your PM textbook. Just work to contribution. And we can also spell contribution, right? Can't we? There it is. All right, now, if you remember, we said we cannot compare the cost of producing 40 against the cost of producing 38,000. Guys, I'll be working to thousands in this demo to save time, just to make it more readable. And because of that, we've got to put in a flexed column. Flexed column is going to take 38,000 from the actual. And we got the unit level items here from the budget, also known as the standard cost card. $65 per unit for materials, 20.8 for material, 65 for the selling price, 20.8 for direct materials, 16 for labor, 8 for variable overheads. I've reproduced those standard cost card lines right there, so we can go fast. Now, the flexed column answers the question, what should happen when we do 38,000 units? So when we sell 38,000 units, that should be 38 multiplied by the standard revenue. We should earn 2,470. when we produce 38 units, it should cost us 20.8 per unit. You get the idea? So I can copy those down. And I copy the total. There we have it. A complete P&L for controlling purposes. Now, with this in place, I can answer the question. We wanted 808 contribution, but we only got 361 contribution. Why? What went wrong? Well, team, the first thing that we do is we're going to look at the difference. Going to compare the bottom line between the budget and the flexed. Right here, the bottom line between budget and flexed. And why is that lower? That is lower only because we sold 2,000 fewer units. That is known as the sales volume variance. Now, a common mistake is to use the top line here. It's the name of the variance is sales volume, so people go here. But guys, that doesn't really work. Yes, we earn less revenue if we sell fewer units, but we also incur lower variable costs. So the net impact, the net effect of selling fewer units is less contribution. So that is called the sales volume variance, and that's going to be equal to the flexed contribution minus the actual. We get a 40.4. Now, the other way we can calculate that, guys, if we just want to calculate it standalone, what I'm going to do is step 1, contribution per unit. Okay, and we could get the contribution per unit, couldn't we? That's going to be equal to the selling price right here minus the variable costs. So if I do an underline there, so if I get the net of that equals the sum, that's going to be the contribution per unit, 20.2. Okay, so the contribution per unit is 20.2. And the budgeted units, we could say budgeted contribution, that's going to be equal to 40 times 20.2. Flexed contribution, that's going to be equal to 38 multiplied by 20.2, and we get the difference. I'm going to do it from the bottom minus the top, so it's negative, just to reinforce that it's adverse. Because we sold fewer units. So right away, we see that it's got fewer units. Now, you can use algebra to slice it and dice it any way you want, or arithmetic. So the way the book often says we're going to do the change in units, we can also do that. 38 minus 40, the change in units times the standard contribution per unit. And we can get the same number that way. Okay? Team, that is the sales volume variance right here. And that is the only time we come to the original budget in this exercise. Next thing we want to understand is the impact of selling at a lower price. So now we're comparing flexed revenue to actual revenue, guys, and that would be simply equal to 1. Let me get the highlighter out of the way. I can't do the Excel functions when the cell is highlighted. And look at that, negative 76. So we know that the sales price variance is adverse. That tells us that we earned less revenue from a lower selling price. So the sales manager in this company has some explaining to do. They sold fewer units at a lower price. Now, if we wanted to calculate that one on the fly, just from the numbers without building up this whole table, I would simply do this. Sales price variance. And we know that's about the difference between the flexed and the actual sales. So I'll need the flexed sales, and that would simply be equal to 38 multiplied by 65. And if we compare that to the actual sales, and often we can just pull that from the question, and we see that that's 2394. And then the variance is simply the difference between those. And there we have it. If we wanted to calculate that just with the standalone variables, well, we would have to do a side working for that. We would get the actual price, so I'd get this revenue here, divided by 38,000 units, that's $63. So if I wanted to do it on the fly, I would go the change in price from 63 is the actual price minus the standard price, 65, times the actual units, 38. And put that over there, put an equal sign in front of it, and we'll get the same number. Okay, so guys, that is the sales price variance. Lots of ways to calculate it, but it is the difference between the flexed and the actual revenue lines. So just to recap, team, when we're talking about the sales variances, volume is about units, price is about price. When we're doing sales volume, we're doing the budget versus the flexed bottom line, right over here. When we're doing the sales price variance, that's flexed versus actual, and we're looking at the top line right here. Okay? So that's a review of the sales variances, team. I'm going to copy and paste these out of the way for now. Cut and paste them over here. Now let's get on with the materials variances. So we did the sales volume, sales price, and then the materials variances, again, it's going to be flexed versus actual. So it'll be equal to the actual minus the flexed. And I can copy that down. And boy, this company has nothing but bad news. So when we look at the materials line, when we produce 38, we should spend 790.4. We did spend 836. So we see that the total materials is also adverse. We see that the total labor variance is also adverse. They should have spent 608. They did spend 798. Likewise for the variable overhead variances. So we have the total variable overhead variance, adverse. I just took a moment to clean it up so it looks nicer with consistent capitalizing. Guys, now we understand why the actual results are different than the budget. We are lower. Our actual contribution is lower than our budget because we sold fewer units at a lower price and we overspent on every input. So we had a disastrous quarter. Now, when we come to the variable costs, we have to answer another question. Each of the variable costs has two components. We've got the amount of the input and then the rate, the monetary value, and then the amount. We got the amount of hours, of kilos, and the cost per item there. So now we have to get to the bottom of these total variances. What happened? Did we overspend at the supplier? Or were we wasteful? Did we just spill a lot of the inputs? So we spent more because we used more. This is where the breakdown of the variances comes in. And let me show you my approach for that. So watch what I do here. For the direct materials, I am going to write 3 sets of letters. I'm going to write AA, AS, SS. Alphabetical order so I can memorize them. Instead of memorizing 17 formulas for PM, I'm going to memorize 1 set of letters. AA, AS, SS. Okay? Now if I'm doing materials, I'll change it. Actual quantity, actual price, actual quantity, standard price, standard quantity, standard price. Look at that. So I'm just plugging in the name of the input and the rate. Now, we have one mystery. Look at this. We know the actual spend. We know the actual price that we paid. We don't know the actual quantity. But if we took the actual spend and divided by the price that we paid, that would come to 190. 190 kilos were put in at a price of 4.4 to give me a total cost of 836. So let's come back here. Anywhere that I see the actual quantity, I'm going to put 190. Actual price, we said 4.4. Standard price just comes from the cost card right over here. 4. Now, the standard quantity, team, that is for what we produced, 38. We produced 38. 1 unit should take 5.2. And we should spend 4. Now, this is really just the flexed budget. This is really the actual spend, guys. And we're going to still go from flexed to actual, like that. So let me just copy the figures down, 1 row. Let me put an equal sign in front of it, and we'll get the result for each. And as you see, the flexed is there, the SS is the flex, the AA is the actual. Now look at the beauty of this. I can look at my variables and I can see between AS and SS, it's the quantity that changes. Quantity is about usage. And all I have to do is compare this one to this one, the SS to the AS. And we see 30.4. The number is positive, so we can say that it is favorable. And if we interpret that number, when we produce 38,000 units, we should use 790 worth of materials. We did use 760. So we used less than expected. We saved money there. That is the usage variance. Now, the price variance is the other side. And I can just copy that, can't I? Because we're using relative cells, and it's a negative. So here we're saying, when I go to the shop and I buy 190 kilos, I should pay 760. I did pay 836. I paid more. I chose a different supplier potentially, or I bought a different grade, higher quality, or I was a bad negotiator. Okay, so that would be adverse here. And then, if I did this correctly, the total variance should be adverse, and it'll just be the sum of these two. Equals that, plus that. Negative 45.6. And does that match my budget here? Yes, it does. 45.6. So now we can understand. Why did we overspend? Well, we paid a lot more for the inputs. We actually used less, so we saved on units, overspent on price. Maybe we bought a higher quality goods. Now, guys, I'm not getting into the operational and the planning yet, okay? So we're not getting into the details. This is a review of the basics. Guys, I'm going to copy this down here. And I'm going to delete that. And the last thing that we have to do is the total labor variance. Okay, team? And I'm going to do the same thing. I'm going to go AA, AS, SS. However, we're talking about labor, so now I just change it out. Actual hours, actual rate, actual hours, standard rate, standard hours, standard rate. If you want to pause the video now, see if you can get it on your own. Pause the video, take a moment. It works exactly as the materials variance did. So pause, try it on your own. All right, let's go together. Well, team, we got to get the actual hours. We're going to do that by finding the actual spend. And if we divide that by the cost per hour, which they said was 25% higher than the budget. So look at that. 8 times 1.25 is 10. And we get a 79.8 for the actual hours. So I could plug in 79.8. 79.8 actual hours multiplied by the actual rate, 10, multiplied by the actual rate, 8. And when we produce 38,000 units, each unit should take 5.2. That came from the cost card. So that would be the actual hours. And then we multiply that by the standard rate, 8. Okay, there we have it. Copy this down one. Put an equal sign in front of each. That's a 2, not a 5.2. So that's going to be 38 times 2 times 8. And there we have it. Our variables. Again, this is flexed. This is actual spend. Now, in the real exam, of course, you don't have to calculate this. If they give you 798 right here, you can just park it there because AA is the actual. Okay, now that we have that, we use the same approach that we did for direct materials. Over here, it's efficiency. And we can say, when we produce 38,000 units, we should use 608 worth of labor. We did use 638.4, so we were less efficient, weren't we? That's going to be equal to this one minus this one. Number is adverse. We're still going from right to left. And let's tell the marking team that that is adverse. Now, over here, we have the rate variance, guys. When we look on the labor market and we want to buy 79.8 thousand hours, we should pay the workers 638.4. We did pay 798, so we paid more. Maybe we paid skilled worker for higher skilled workers, or the market changed as they told us that in the story. That'll be equal to that one minus the 798 equals this one minus this one. And as we see, that one is also adverse. So we overspent on labor. That's one of the big culprits, isn't it? And we could say that total variance will be the sum of these two. And that should match the 190. Does it match the 190? Yes, it does. Ladies and gentlemen, that is the labor variance breakdown. And that is everything that you need to know from the MA exam. These are the 4 variances that come up in MA. The sales volume, the sales price, the direct materials, and the direct labor. Remember your letters, AA, AS, SS. If you can remember those letters, you can do the mix and the yield variances and the planning and the operational variances. The sales volume variance is also very important because from this we get the sales quantity and the sales mix variances and the market size and the market share variances. Now, that concludes our review of the basics. If you want to keep rocking with your variance analysis question, I've got tons of videos. You can find the link. You can find links to the videos below in the description here. Team, I hope you enjoyed that review of the basic variances that you need to know for the ACCA PM exam. If you have any questions, park them in the comments. PM team, this is Steve signing out for now. Good luck on your upcoming exam.